Hi guys, welcome back. As I promised to you, in this video, I'm going to teach you this template which we can run to DCF of a company, listed company. Guys, this is a quick and fast way of doing DCF valuation because using this template, you can complete DCF valuation of a company in less than 1 hour. Okay, so we'll first understand flow of this template. We'll understand, how this template works, and then we'll apply this template on the real companies, listed companies. Guys, in this template, we are going to use two sources of information. One is coming from the screeners. Okay, we discussed in the previous video. Okay, screeners is what? Screeners provides you companies data which are listed on the market. And we'll also use another source which is market screener. Okay, so market screener is used for sourcing estimates because DCF is based on the future projections, future cash flows, right? So we'll source estimates directly from market screener. In case you want to do your own estimation and you want to use your own estimates, you are free to do that. Okay, you have to provide your input in the estimate cell. Okay, but before we jump to the company's numbers or real company's valuation, let's quickly understand flow of this template. And before that, I'll say let's quickly understand color coding of this template. So guys, as you can see in this template, I have two types of cells. One type of cell is numbers, or the cells where you are supposed to punch numbers. You need to hard code numbers. Okay, right? So these are called input cells. And the other type of cells are formula cells, where formulas are pre-entered. Okay, you're not supposed to write any formulas there. I've created this template, so you can use this template, and I'll provide this template in the link of this video. So formula cells, where formulas are already there, calculation will be done automatically. You're not supposed to overwrite them. Okay, so you are supposed to provide input only into these input cells. Okay, now color of these formula cells would be yellow to differentiate formula cells from the other cells, right? So you can see, guys, in your template, say this cell, this is beta is coming from the formula cell, average rate is a formula cell, interest rate is a formula cell, tax rate is, because it is linked from somewhere else, formula cell, value of equity formula cell. So anything which is linked from somewhere or where the formula has been input, has been incorporated, it would be colored in yellow. Other than yellow cells, all other cells are input cells. So for input cells, I'm using two type of colors. One is gray and one is light blue. Okay. So gray is for the historical numbers and light blue is only for the estimates. You can see, guys, historical data. This is for historical year numbers and this is for future estimates. Okay. So let's quickly understand flow of this template. First of all, guys, you need to put name of the company here. Okay. So name of the company, say ABC Limited. I'm not taking any actual company here. So just ABC Limited. The moment you put company name, you will get the company appearing at the top of the sheet also. Then, guys, you need to provide currency, right? Your numbers are into which currency? Your company's numbers are in INR or USD or, GBP, whatever. Now, you have to provide the last fiscal year. Fiscal year is what year number company has published in the last annual report. Okay. So for example, in case of Indian companies, they are already done with 31st March 2025. So I can put here 31st March 2025. Okay. Now the latest quarterly numbers reported by the company. So after a year, after reporting complete year, most of the companies have already reported September 25 numbers, right? So we are into December now. December filings are still not out because it will be out in starting from the January, right? So last quarterly numbers reported by the company say 30th of September 2025. Okay. Then, guys, you need to provide here valuation date, on which date you are doing this valuation. So because I'm doing this valuation today, and today is what? 18th of December 2025. That's my valuation date. Okay. Now, after this, you can see, guys, first set of data. Okay, here you can see I'm putting here sales number, EBITDA number and EBIT numbers. These are the three important numbers coming from income statement of the company, P&L account of the company. Sales, EBIT and EBITDA. That's it. And guys, you can see as my last reported year is 31st March 25, so I am taking last 4 years ka historical data starting from March 22 and ending on March 25. This is the actual data what company has reported. That's why I'm calling this data historical data. So I'll provide here sales number, then EBIT number, EBITDA number, and then EBIT numbers, okay, for all 4 years. Now, after this, I'll put estimated numbers here. You can see I'm taking next 3 years estimated numbers, March 26, March 27, and March 28. Now, these estimates, now source, right, from where we'll get these numbers. Guys, these actual numbers I can either source from the company's annual report, quarterly reports, okay, basically the company's financial reports, what company has published, or I can source this data from Screener. So Screener also provides you historical data, okay, if you don't want to dig into company's filing, right? So you can use Screener, okay? And in the last video, I'll also show you how we can automate this sourcing, by creating a template on Screener, right? So this will also save you another 50% time. So after 1 hour time, where we are using to put these numbers, actual numbers from the historical filings, you can automate this process. You're not supposed to do this punching, linking manually. This number can be automatically sourced from Screener by using a template, okay? Now, from where we are getting these estimates, guys, these estimates will come from Market Screener. Now, here, one disclaimer. This Market Screener, the limited use of Market Screener is free, okay? So if you want to search limited number of companies in a day, then you need not to buy any subscription here to get these estimates. But in case you want to do this search extensively, then it will ask you to buy some subscription, okay? Then it's up to you. It's not very expensive, but yes, if you do limited searches, then it's fine. You know not to buy. Then guys, you can see the next input is you need to provide a period of projections. Basically, you need to estimate, okay, till what time your company will remain into high growth phase. Because remember, in the previous video we discussed, you have to keep your projection on till the time your growth is not constant, till the time your company does not reach to the maturity stage. The moment your company reaches to the maturity stage, you can stop the projection, because then Gordon's growth model will take care of this estimation on its own. So I'm assuming here 8 year, but you can assume 5 years, 6 year, whatever the growth stage of the current growth stage of the company. If the company is already into maturity stage, you can even reduce this to 3 years. Okay. So there is no such hard and fast rule. You have to keep this projection on for 8 years only. Long-term growth rate, guys. So here you have to provide the growth rate, what company can sustain forever. It's pure estimation, guys, because nobody knows what growth rate company can sustain for infinite period. But we assume this growth rate close to the GDP growth rate of the country. We assume that the company is going to mature close to the GDP growth rate, or another, basis of assumption could be, another assumption could be for this long-term growth rate, risk-free rate. So we can assume this LTGR, either risk-free rate or GDP growth rate of the country. So for example, I'm assuming this long-term growth rate 5%, though my GDP growth rate is 6 to 7%, but I'm assuming this growth rate will get matured. So at least my company can sustain 5% growth in the nominal terms. It's a nominal growth rate. It's not real growth rate. So, and considering the inflation effect also. So that's a very reasonable assumption, guys, for the Indian companies, because your cost of fund will also capture impact of at least 2 to 3% of inflation, right? Tax rate is 25.2%. That's a corporate tax rate. Okay. Now, next is cash flow statement. Key assumptions from the cash flow statement. So what assumptions are required from the cash flow statement? We need capital expenditures, right? So these capital expenditures will come from the cash flow statement under cash from investing activities. Again, guys, this historical data can be directly sourced from the screen, not Market Screener. Source would be Screener. So let me correct this. This source would be Screener. And guys, for the future, either we can take it from the Market Screener or we can do the estimation also. So future capex would be whatever. If you have your own estimation, you can put it here. You can take it from the Market Screener, fine. Or otherwise, you can apply some assumptions here. Well, I'll show you when I'll apply this for the real companies, okay? Now guys, the next is we need to source some numbers from the balance sheet. Okay, so what balance sheet numbers are required to do DCF? As remember guys, we need to make adjustment of capex. So EBIT minus tax is NOPAT. So EBIT we have already taken. EBIT is your operating profit to the firm. Tax rate is already there, right? You got your NOPAT. EBIT minus tax NOPAT. Then guys, plus D&A minus capex. So plus D&A. D&A is nothing. Depreciation amortization is difference between EBIT and EBITDA. So D&A is there. Minus capital expenditure. Capital expenditure is already factored. So in free cash flows to the firm, only one component is left. Let me show you. So that was my equation for free cash flows to the firm. See? So free cash flows to the firm. Let me show you here. Yeah, this one. Remember? So free cash flows what? It was starting with EBIT, less tax on EBIT, NOPAT, plus D&A. So we got D&A also, less capex, we got capex ka projection also. Now what is left is working capital. So working capital is current assets minus current liabilities, which comes from the balance sheet. So we need operating current assets and operating current liabilities. And then guys, at the end, we need some numbers of the debt balance, cash, minority interest and all to arrive at the final value. So you can see that this debt balance, minority interest, cash balance, investments, all these numbers will also come from the balance sheet. So finally, how these numbers will be used to arrive at final DCF value, we'll understand when I'll apply this for the real company. Now guys, discount rate assumptions. So discount rate assumptions. And guys, one more thing. Here you can see I'm using this detailed version of working capital change, but when I'll use this template for the real company, I'll gonna to show you a smarter and the shorter version of this working capital calculation, where I'll directly get working capital from the market screener. So I need not to deep dive into this inventory, debtors, etc. These are the individual component of current assets and current liabilities. So I can directly get this number from the screener. Okay. Now, discount rate, guys, as we discussed, discount rate is what? Weighted average cost of capital, cost of equity and cost of debt both, right? So cost of equity, remember we discussed. Risk-free rate, you need to put here 10-year government bond yield. Beta will come, which is what risk of the company. So as this is a formula cell, it means it is linked from somewhere else. I'll show you. Equity risk premium is the risk premium what extra return market has earned over and above risk-free rate. Source, I'll tell you. This assumption is easy to find. Cost of, so this is what? Cost of equity. Now cost of debt is what? Interest rate. So for interest rate, I need interest expenses divided by total value of the debt. So if I divide interest expenses by average debt outstanding during the year, I'll get my interest rate. Now from this interest rate, I'll subtract tax impact. So I'll get net of tax cost of debt. Okay. So in my output, you can see DCF output, this calculation will be automatically done. So you know the concept of cost of debt is what? Interest rate into 1 minus tax rate. So interest rate is what? Interest expenses divided by average debt outstanding. Okay. So interest expense of the last year, say my last year interest expense was 500 rupees and my average debt outstanding was 5,000 crores. So on 5,000 crores of debt, I paid interest of 500 rupees. So it means my interest rate is what? 10%. So this template is calculating this interest rate automatically. You just need to provide interest expense and average debt value here. And average debt value, it is linked. You can see, I can show you this link. It is linked from your balance sheet, right? So you provided this debt balance, which is coming from the balance sheet. So, right. So this debt balance is required for latest year and for the last year, and average of this debt balance would be your average debt outstanding, which will be used to calculate interest rate. And this 10% is pre-tax cost of debt. Now, this pre-tax cost of debt will be netted off with the tax rate because you will get tax benefit of it. Cost of equity, as I explained you, risk-free rate, beta and ERP. Beta is coming from this calculation below. So now how we calculate beta? Let me first explain you this calculation. Okay, so beta. So beta is what, as I explained you in the previous video, beta is what? Risk of the company, riskiness of the company versus market. Market is your index. Market means what? How we define market? Market means, say, Nifty 50 in India, right? In India, primary index is Nifty 50, right? Now, how do we calculate this riskiness, guys? We simply say this riskiness is nothing but the volatility of stock versus volatility of market. How volatile your stock is versus market. And this volatility can be measured with the stock price change of the market versus index change. So we normally calculate this volatility or beta or risk, anything, usually based on last 3 years weekly price data, weekly price behavior of stock versus market. Okay, I repeat. So we calculate this beta normally. That's a normal practice. So usual practice I'm saying. But in case your firm is following a practice of calculating beta based on, say, last 1 year data, you can follow that. Or they are following a practice of using 5-year data, you can follow that. But the usual practice 3 years, because 1 year is too short time frame to understand the risk of the business. 5 years too long time frame because over the period of time, company's risk changes. So most of the time, we see that the models use 3 years price data to understand the risk of the business. Now, how this beta calculates, how we calculate this volatility. So we have a very simple, in Excel, we have a formula to calculate this beta. We use a slope function here. So slope, change in stock, comma, change in index. Index is what? Nifty 50. So you have to use this function. I'll show you how we can use this function. Slope, change in stock versus change in index. Okay. And you have to, link all the 3 years ka change. Okay. So this way you can get beta. And let me show you how we can calculate beta here. So though it's a formula is already there, but let me delete this formula. Okay. So that I can show you this calculation. As you can see, guys, in this beta calculation, I'm using 3 years ka weekly data. And I have 3 years weekly change of index and ABC. Now, ABC is not any company. I just used a random name here. But now, to understand this calculation, let's use a real company, okay, to understand how the beta calculation works. So let's calculate beta for Infosys, okay. So let's say I'm doing this valuation for Infosys. So let me put here Infosys. Okay, I want to calculate beta of Infosys. Now, I need last 3 years ka data of Infosys versus index, right? And because I have put here my last date of, ending date is 27 September, but I can change this date. Say, I want to calculate beta today, right? So my ending date is 18 December 2025 and starting date would be 18 December 2022. So I need last 3 years ka data of market versus stock. Now, to source this data, we first need to source this data, right? So to source this data, I can use this portal, investing. I can go to investing.com. Okay. And then, guys, here I'll search first Nifty 50. That's the index, my index with respect to which I need to calculate beta. Just search this index. Click OK. Now, guys, you can see this is the latest price change of index, but I need to go to historical data. So just click on historical. So this is my historical data, guys, of Nifty 50. Now I can change my time frame here. So instead of daily, I want weekly change. So just click on weekly. Here I need to change my date range. So starting from say 18 December 22 and ending on 18 December 25. and click OK. So the moment you click OK, you will get last 3 years weekly change of index, and just click on download and you will get this data. Okay, so you can see I got this data in spreadsheet. So now what I'll do, I'll just copy first this date, range of date, and I'll put this, update this date range here because my date range was a bit old. So, okay. Now I'll put my index ka price. This is the column B. Just select Control C and Control V. I got my market change. Now I need Infosys change for the same period. Change in the Infosys price. So I'll search Infosys. Okay. Just click on it. Historical. So just click on historical. And I'm sorry. Yeah. Then weekly. Change the date range. Apply and download. Now guys, just open this spreadsheet, which is the share price change for Infosys. Just copy column B because we already have date range, right? So corresponding to this date, this is the price change. So we got stock price change, weekly change in the market, and stock. Okay. Now to calculate beta, if you remember slope function, so I'll put here in this cell. I'll use slope function, slope, bracket start. First, it is asking you to link Y. So Y is what? Your stock change. Okay. So Y is dependent variable and X is independent variable. So your stock price movement is dependent on the market, right? Not the market movement on the stock. So Y means always stock price change. So link price change in the stock, this entire array, comma, link this market change. Again, this entire array and enter. Okay, so I got this beta 0.36. Let me verify this. This data is not there. And there's something wrong with this data. Yeah, so this beta is not correct. I think this data is not completely. Yeah, Infosys data, and let me check. Yeah, this is wrong. It has not fetched last 3 years data. I need to download this again. Yeah, it's starting from 22. So again, I'll go to apply and now download. Hopefully I get 3 years ka data now. Yeah, I got 3 years ka data. Yeah, this is fine now. So just copy and paste. Yeah, so beta is 0.93. It's not 0.39, it's 0.93. Okay, almost 1, right? Close to 1, close to market risk. So guys, this is how we calculate beta, which is one of the input for cost of equity. Risk-free rate, I can source it again from the web. Risk-free rate is what? 10-year Indian government bond yield. I just click on it. 10-year bond yield from the investing. It's 6.06%, right? 6.606%. That's my risk-free rate for India. Then guys, for equity risk premium, we can source this number directly from the Damodaran's ERP sheet. So Damodaran update this ERP for every country at the start of every year. Or we can calculate this ERP just as a difference of market return, average market return for the long term, maybe last 15-20 years, minus the risk-free rate, what we have just taken, 6.6%. Okay. So both ways we can source this. So I'll show you how we can get this, this ERP in the next video. when I'll apply this for a real company. So guys, I have explained you this basic input sheet, assumption sheet, and based on this assumption sheet, I've created this output, which is completely linked. You're not supposed to put any assumption here, any number here. This output will automatically calculate DCF value of your company, target company. You can see all the calculation is auto-linked, okay? And at the end here, it will provide you DCF value per share, okay? So you just need to provide those assumptions in the first sheet and then you're done. Okay. And then you can compare it with the current market price to see whether the stock is overpriced or underpriced. So in the very first video, we discussed, how we can find good company as per market screener. Then we discussed concept of DCF. Then in this video, we discussed this template, which we'll use to find a DCF value for company. And in the next video, I'll apply this template for a real company. And in the last video, guys, I'll show you how we can automate this function, how we can cut down this process of sourcing historical data, directly from screener. Okay, so I'll be using one template from the screener. So this is a 5-video series and this is the 3rd video. And in the 4th video, we'll apply this for the real company. See you there. Thank you.